a week ago now, we had a record of 110 million options contracts trading in the U.S. market. I mean, that's insane. Average daily volume in the U.S. options market is about 70 million, 65 to 70 million now. So Friday was just bananas in terms of the amount of volume trading. If you woke up this morning and said VIX is at 27, you'd be going, oh, shoot, I don't even want to look at my portfolio right now, right? But you look at it, you're like, oh, well, I mean, if you don't know anything OpenAI related, you're actually probably still up on the day. When we have these types of positioning in the market, and this type of positioning in the market is negative gamma for dealers, which means that dealers have to buy the market when it rallies and they have to sell the market when it drops, and there's no stability. We hit a record on 9/3 of 70% of SPX volume basically being 0-DTE, which is crazy. And so what you suddenly see here is that flow on the 10th, and particularly on Monday, just kind of disappeared. Not fully disappeared, still 55%, but that 0-DTE volume recedes in a major way, and that positioning recedes in a major way. And then what I think that leads to is less stability in the market.
So Brent, I don't know if we could say volatility is back, but we were at least seeing a little bit of a spike in volatility here.
It's back. Absolutely. The VIX hit 27 yesterday, and realized vol went from incredibly low in September, and we were talking about like how crazy low it was, to now things are moving, and it's nice. But what's weird about it is, though, the vol is going crazy, but the market's not really doing that much. We were just talking about this before we started. S&P's down for like 1-2% from all-time high, but you have VIX at 27 is like, that doesn't make a ton of sense, right? So we got to wade through that today.
Yeah, and we're gonna spend some time talking about what happened on Friday when Trump had that tweet. But it is interesting. There hasn't been there was a little bit of panic, but then there's not the follow through. It just seems like a weird market. I don't know if that's the right way to describe it.
No, weird is the right way to describe it. And I think how I'm going to try to set this up, and as you can see the title of my presentation today, you are always asking for easy ways to promote YouTube videos, and so I've been trying to come up with stupid headlines. Like last time we did K-pop vol hunters, which is like, where's the vol? And we got it. And now this one is things got stupid, and we're going to explain why that is, but there's your YouTube headline. So what specifically was it? Well, to understand how we got here today to the 27 VIX with the market only down 1%, we have to know where we came from, which was like realized vol was dead and people were falling over themselves to get calls. And on that point, this is my chart, this famous meme where if I whisper in your ear, Jack, OpenAI, you just buy it, right? You don't know what you're buying, you're just buying. And over here we have Intel, AMD, Avgo, all just said, hey, we made a deal with OpenAI, and they're maybe going to buy $3 trillion worth of GPUs from us. And then when you hear about the actual deal, it's like, well, their GPU first have to like prove that it could work. It's not even a done deal. It's like everything is just kind of a circle, right? This famous chart now of like NVIDIA in the middle, and it's just round robbing GPUs to everybody. And that's where we were, right? And the thing that's important about that is because the manifestation of all this is AMD jumping 35% on an OpenAI deal, Avgo jumping 15% on an OpenAI deal, Intel, which was the worst stock ever, suddenly getting allegedly deals. I don't really know. But how this manifested was people just falling over themselves to get calls and anything tech related. And so that is how we got here, right? Incredibly low market movement, low realized vol, as low as we can get, along with people piling into single stock calls in a giant chase. And then suddenly all of this has unwound. And when you get this giant unwind, you get things like what happened on Friday, and you get this weird environment that we're seeing right now where VIX is at 27, even though S&P is only 1% off all-time highs.
So do you want to like announce SpotGamma's deal with OpenAI now, or do you want to save that to the end of the podcast?
I mean, it's probably as real of a deal as any of these other ones, I guess. Everybody, I use ChatGPT. Maybe that will make you buy your SpotGamma.
That means you do have a deal with OpenAI right now, right?
I should trade make a ChatGPT AI subscription to SpotGamma and charge $10,000 for it. People are like, oh, I don't know what that is, but here's my money. Take it.
Right. It is interesting though, just as we get into this, you were talking about, this is something we covered a lot in the last, and we'll get into it, but you did cover this idea that, realized vol was low. It didn't seem like it could go that much lower. Like implied vol was low. It didn't seem like it could go that much lower. And, we did finally we saw sort of those spikes that wasn't good. You didn't think that was going to last, and it did.
Yeah, we spent a ton of time talking about the correlation index, Core 1M, for example, and saying you got to watch that as like the risk barometer, because, and we're going to talk about this also where we stand right now, because this idea of you getting stretched because people pile into single stock calls at a rate that's just excessive right? You can see that in the implied vol space when that starts to happen. And the problem with that is if you bid up single stock calls enough, they hit prices where they're not going to pay off anymore. You could still have a nice rally, right, in a stock, and the calls won't pay off because you overpaid for them, right? Because the call options are ultimately about the probability of something happening. And if everyone thinks that a stock is going to go up and they're paying more and more and more for that, well, guess what? Like at some point, you paid too much, right? And then
That's the whole GameStop thing, right?
that's the GameStop thing, and that's been happening a lot in these markets. And so that's one thing you have to be, I think, very conscious of now, because the options market keeps getting bigger, the derivatives market keeps getting bigger, the impact on this stuff increases, and the nice thing about watching the options market is you see the price people are willing to pay, right? Like, on one hand, I'm like, Jack, how bullish are you on the stock? You're like, I love, Nvidia. I own 100 shares or whatever. It's like, okay, you own the stock. That doesn't really mean anything. Like, you own the shares. That doesn't tell you the relative bullishness in a way that, like, if you look at the implied vol of a call and you own a call at 400% implied vol, well, that is an expression of just how bullish you are, right? It's telling you that you own it at a level that is as bullish as it's ever been, kind of thing, right? Hopefully that explanation kind of made sense. It's sort of like a relative ratio of bullishness, I guess, when you look at the implied vols. And a lot of that is tied to volume. So this is a chart that we've shown in a while, just the how much options volume has increased over the last many years here, and that's up 150% in terms of volume versus the stock. And now we would argue that more derivatives come on, more options come on to the market. There's still hedging flows, which drives volume in the underlying, but you can see that gap. And then on the 10th here, just a couple of days ago, and into that was also pretty wild in terms of call volumes. We're going to talk about that towards the end of this presentation. So the impact of the options market only seems to be increasing, which I think is a really important thing to note here when we talk about how crazy things are getting in terms of bizarre moves like what happened on Friday, and even like where we stand now, where again S&P is down 1%, but VIX is at 27, and you're like, why is that gap there? That doesn't really make sense, right? So
And I always feel like, are we exaggerating this? But then every time we do a show, it's always like, we had another day that was the biggest options, volume of all time. So it's like, you can't exaggerate it too much. It just keeps going.
It keeps getting bigger. And then, I have to start covering the ETF space, I think, more too, because now we have more ETFs than single stocks, which is crazy. A bunch of new 5X levered ETFs were announced. And I think a lot of that stuff feeds into the options market, which is why it's kind of relevant to me. But also, if you just think about the derivative mattering more than the underlying, it's like, this is all kind of crazy. It's like the financialization of everything is just like accelerating at a pretty wild pace, right? And
you and I need to do an episode on ETFs at some point, just on what's going on behind the scenes, because there's so many ETFs that use options in so many different ways now. And some are probably not in the best interest of the end user. So it would be something we should do an episode on, like separate from this at some point.
Yeah. And a lot of that stuff trades on swap. And I think for the most part, those markets operate pretty well, but the more ETFs we add and the more, levered they get, how much, how much are banks and liquidity providers willing to offer on swap when things truly get bananas if we get a big down move? I mean, that's definitely, like, I think, a lurking risk. And I know enough to know that I don't know everything about that space, but I feel like there's definitely like something lurking there that we should all worry about, like flash crashy kind of stuff. But that's a story for another day. And on this point, we always cover this quickly. The way that this works is if we all go and buy calls like NVIDIA or AMD because they made a deal with OpenAI, in this case, this is AMC, but just replace AMD, market makers provide 90+% of the liquidity in the options market. So if Jack, you and me are both going buying AMD calls, that means that the market makers are short those calls, right? And they have to hedge. And when they really got to hedge, they buy stock. And just to give you an example of the impact of that, 100,000 at the money calls typically have a 50 delta. So just as a rough approximation, 50 deltas on 100,000 calls is 5 million shares of AMC to buy. And they would have to buy that very quickly in this instance where everyone's piling in on a big headline. So that is the initial hedge, right? Just for that trade. And then obviously, as things change, stock price moves, time passes, implied volatility shifts around, then hedges have to be adjusted. And so these are the dynamics that we are watching because we know what open interest is. Our new SpotGamma tools tell us exactly how the buy side is positioned. So we know what the dealer exposure is to, say, big hedge funds in retail. And then we model out how dealers have to react to changes in time, price, and volatility. And that's all what these OPEX conversations are about.
And the reason we do this on the day, and today we're doing on the actual OPEX, usually we do it the week before, but is when we get into today, leading into Monday, things are going to change, right? Because we've got all these options expiring.
That's exactly right. And the way that this works is the third Friday of the month is the big expiration. So positions build into that Friday, and hedges associated with those trades, in theory, build as well. And then on expiration, those positions go away, right? The options positions go away. So in theory, you don't need those hedges anymore. And so the way to think about this is that the behavior of the market, or the positions that reinforce the behaviors we're seeing, in theory, reset, and that changes the kind of complexion or the way that markets are reacting. Now, this is a weird market because we went from super calm to a week ago, things have gotten wild. And so I think, and my kind of like gut instinct here is that we're going to see vol potentially settle down. Now, there's a couple of dates we have to watch about that first, but we have data that shows us, and I'm going to point to this one, where if you go into an expiration with high implied vol, right, what tends to happen is volatility will mean revert after those expirations. And you think about that, why? Well, if puts are very expensive, or there's a ton of VIX positions out there, right, and you know that VIX call is going to expire in 2 days and VIX is at 27, I'm incentivized to probably sell that call and roll to something else because I know that position expires in 2 days or it expires in a couple of hours. So in this case, what you can see is if we go into expiration with a low implied vol spikes. But on average, if I was to show you this chart as well, I didn't include it in here, I should have, my mistake. If we have high implied vol, it mean reverts to lower implied vol. So it's a binary, like vol flips. And I think that's a critical point to make here now as we head in Friday here with VIX at 20 to 27. It feels like into next week, we're going to see vol mean revert, not just on the OPEX positions, but VIX expiration next Wednesday. And then we do have a couple of dates coming up, and there's a credit market issue. So, take all of that with a grain of salt. But I would think that this OPEX is maybe going to settle vol a little bit.
Well, my YouTube thumbnails are not going to like this vol is going to settle down, Brent. So we got to strike that from the record.
I can get angry and say, settle down.
Right, yeah, exactly. I need something. I can't put a fire around that thing.
Yeah.
When was the VIX expiration?
You could light the VIX on fire.
Yeah, maybe you could do that. Did the VIX expiration already happen? I should probably know this.
It's on Wednesday. It's coming up.
It's after this time.
That's exactly right. So,
and to this next chart, that talks about sort of how that impacts how we're seeing all this stuff.
Yeah, and if you look at the performance slip, so if you look at how S&P prices perform into expiration, it actually matters whether VIX expiration occurs before or after OPEX. So when VIX expiration is before OPEX, we see the S&P flip week over week performance-wise. So if the S&P, was rallying into OPEX, 2/3 of the time it sells off. Now that VIX expiration before or after decreases that performance by about 10%. So it's still better than a coin flip that we get a performance flip, so to speak. What's weird about this market as well is like we had a very strong rally into last week. Again, all-time highs just a week ago, and now we sold off a little bit, right? So the performance flip and the vol expiration gets a little bit murkier here. And what is certainly stretched now is vol. So if you're looking for something to mean revert, that's why I have vol flagging as the thing that could flip in this market in terms of vol spiking and then coming off. But again, because it's a monthly expiration, the positioning is a little bit smaller, as we're going to talk about here in a minute. So the thing that you want to look at is what is the standout thing, right? Like what is the nail sticking out that's going to get hammered? And to me, that stands out that vol here is a little excessive, and that could get hammered down. And kind of on that point, we look at gamma as a forward indicator of volatility. And in this case, you can see our S&P gamma index is pretty negative. And what that means, this is the forward one-day implied vol, or one-day forward realized vol on the left axis, y-axis. So you can see that vol increases quite a bit, right, when we have these types of positioning in the market. And this type of positioning in the market is negative gamma for dealers, which means that dealers have to buy the market when it rallies and they have to sell the market when it drops, and there's no stability. And on that point, we've seen how many 1% swings now over the last week. I can't even count them at this point. Just huge daily swings. And this gamma positioning is kind of inducing that volatility. So a lot of this gamma is going to go away now today, which in theory could also be a method or mechanism to kind of reduce the swings that we're seeing in the market. So another kind of vol dampener here, I think, because this arrow is where we are today. Oops, sorry about that. I think after expiration, we're going to move more towards this red line in terms of how much gamma there is to sort of induce volatility.
Yeah, one of the things I've learned with this chart is it seems like when the arrow's pretty far to the left, the odds are after expiration it comes to the right, and when it's too far to the right, the odds are it frees up some ability for movement and it moves to the left.
Yeah, because you're reducing the positioning, right? So there's just a lot of positions that are creating the negative gamma in this market. They're going to expire today, right? They're just gone. They don't exist anymore. And the other interesting thing about this is that when you move to the very extreme here, right, all the way to the left, you actually hit this point where it's almost actually an oversold condition, right? Because you move so far to the left that the gamma is inducing kind of like extreme volatility. The next step of that is that actually stability starts to come into the market. And you can see this in some of these data points, right? They don't happen often. And I've always speculated about this and saw in positioning that if you're a market maker, you are net long options, right? You are net long Vega. So that if you wake up and the market's down 20% tomorrow, you actually are going to start to make money because you own all these teeny puts, right? These very far out of the money puts. And you have to do that from a regulatory perspective. But also you can't sit there and be like, hey, market opens down whatever 10% tomorrow and we're at Citadel and we're out of business. Like you just can't let that happen, right? So you carry this extreme tail risk. And what that means is every once in a while we get such an ugly market that tail protection comes in. And I think they can then step up and provide liquidity in that market because they own these puts, right? These teeny puts that are suddenly worth a lot of money. So it becomes actually a place of stability, I think, in those extreme examples. We're nowhere near that, but it's just kind of an interesting point when we're talking about this gamma chart.
So on this next one, we're looking at some events coming up. Obviously, we're at OPEX today. We got DIX next week. I mean, you should probably put like Trump sends tweet on unknown date in the future here because that's probably going to happen at some point, but we just can't predict when. What do you take from this?
The thing that, and I note this again in a minute, is like you see the relative calm we had. I mean, the April stuff is not on this chart, but the daily range is quite tight. Yeah, there was one kind of gap down here in August, but outside of that, like it's been very stable. And then you see this just incredible red bar here, right, from that Friday the 10th where we had that record volume, and that has really unleashed the volatility, and the daily moves have been quite wide. And so the idea here again that these giant candles turn into something more like this, right? More kind of contracted moves, to me makes sense. Now that's a hard call to make because I think we're supposed to get the first CPI print that we've had in quite a while, right? Because of the government shutdown. I think we're going to get one on the 24th. I don't know if that's still true or not. And then we have the Trump Z Asia APAC meeting. I think that's scheduled for the 1st, November 1st. So those are two really big events that vol is going to kind of cling to. But that's implied volume. You talk about realized volume and how much the market's moving. These candles can get a little bit smaller and we can kind of pin into this area, which to me seemed to make sense. And then whatever the outcome of CPI and the Trump stuff and Trump Z meeting, right, can kind of dictate what happens into November.
So as we get to the actual October OPEX here, I mentioned to you before we started that my quick takeaway was it seems a little less call heavy than last time, but what are your takeaways here?
100%. Every, the last 6 episodes of this of OPEX returns that we've done here have had the call weightings be 70, 80, 90%, right? I think in August it was 90%. You go, this is just extreme calls, right? And we get a little mean reversion after that, and then the train would just keep going. And so in this case, these values have dropped about 10% over the last week in terms of the call weighting. So we were at the kind of mid to high 70s. Now we're kind of mid 60s. So this is a much more neutral expiration. The reason that we're not more put heavy is because the market's not down that much. Like if you look at a chart of like the semis, for example, they're flat to where we were before last Friday. So there's hardly a drop in a lot of these stocks. And even though that is the situation, we're still fairly neutral, I think, in a lot of these positions. Just to note, single stocks almost always have more call percentages than puts anyways. So this is pretty neutral, right? It's not an extreme of any kind. Which sort of mutes the price impact to me of the options expiration. But again, it is that vol that's very high relative to this. Like if I was to look at this chart, I would think, okay, the markets must have been pretty weak, right? And the reality is they're just not. Like right now we're trading at 66.50. Like that's again percent under where we were last week, all-time highs. It's not really that negative, right?
Yeah, it's interesting. Like when you get these spikes of volatility, it's just interesting how it changes our perception of things. Like the market's really not down that much. Like if you had asked me, like without knowing how much the market's down, I'd be like, oh, we've got a big situation going on here. But
yeah, VIX,
just these spikes should have changed our perception.
100%. VIX. If you woke up this morning and said VIX is at 27, you'd be going, oh shoot, I don't even want to look at my portfolio right now, right? But you look at it, you're like, oh well. I mean, if you don't anything OpenAI related, you're actually probably still up on the day. And you're like, great. The value guys, I don't know. They're still feeling the pain.
I have to stick that one in there.
How did I get you? Jack is a value guy for those that don't know. All right. Anyways, the October expiration, just to put it in terms of size, this is the Delta expiring today, right? It's bigger than November, not surprisingly, but we're not talking about bigger than December or a big quarterly expiration. So it's a decent size expiration in terms of the monthlies. About a $4 trillion expiration if you look at it in terms of the Goldman notional values that they put out, whereas a big quarterly expirations tends to be about 6 trillion lately. So again, good size, but not records.
And are we gearing up for the quarterly being the biggest of all time? Probably again, I would assume.
The end of the year is going to be very big. Yeah, it always is the December expiration. This one here, I mean, it's always the biggest of the year. There's December because all these end of year positions expire, and so and on that point, we're entering a period of the year that tends to be seasonally pretty strong, right? November into December tends to be the Santa Claus rally. I mean, we all kind of expect that, and I think that's got to be everyone's base case. And it's like, what are you going to do to upset the base case? Talk about this in a second, but now you're going to have Vanna as a nice tailwind out of any positivity into the end of the month, and you got to kind of respect that. And we're also into earnings season, right? Where if you keep this AI story intact, and so far Taiwan Semi and ASML were, I think relatively strong in terms of those earnings readings, then the AI story can kind of like refire as the leader into the end of the year.
Yeah, on the Santa Claus thing, it's interesting. Like, and I think it was Jem Kersano I originally heard this from, but like, we all have this idea of, the Santa Claus rally's out there. We don't even know what it is, but it's interesting, like behind the scenes. I think some of this is options, particularly in an up year, but it's interesting, like how much of that is really just flows that have to occur at the end of the year and not like some magical Santa Claus thing going on.
Yeah, and I think Jem definitely put a lot of much more narrative behind that story of the Santa Claus rally. And overall, these markets too have just been very bullish, like post 2020. It's like stocks just kind of go up regardless, you know what I mean? And so I think that you definitely have to respect this idea that, number one, everyone now believes in Santa Claus rallies at the end of the year. And so if that's just how the flows go and passives just tend to rally and, year-end bonuses and blah, blah, blah. I mean, Jem has definitely done a very eloquent way of explaining why these Santa Claus rallies last. And I just think that you have to pay attention to that narrative. Like, people believe that markets tend to rally at the end of the year, then that's kind of what matters, right?
It's interesting in my world too, this whole idea that, growth stocks should do better with low interest rates. Like, if you actually test that out over 100 years, there's nothing to that. Growth stocks don't actually do better with interest rates. But to your point about narratives, like that's kind of what we saw in this recent thing. Like, people start to believe that growth stocks do better because of interest rates, and they buy growth stocks. It doesn't really matter whether they've done better historically or not. Like, you get these flows based on the belief, and it can change things.
Yeah, that's funny. I hadn't thought about. I mean, I remember I had done actually, and there was the narrative going around too that rate cuts are good for stocks, and then when you looked at the data, rate cuts didn't always produce bigger rallies. Like, oftentimes it's the first cut or whatever that would lead to a sell. That was based on like 3 data points over like 1 year, but that was the narrative. So a lot of these narratives are funny. They're not necessarily kind of based on truth. And then not only that, there's so much changing now in the investment landscape that it's kind of hard, I think, to, like, if you look at the options volumes, right? Like, these positions didn't exist in any year before 2020. Like, the volumes were a fraction of what they are now, right? So when I'm going to compare a market today to like what happened in 2000, it's like they're not the same market at all. Like, I almost feel like I've just thrown out all that history because, like, for at least for when you're looking at the options landscape, it's like there's no parallel before 2020, right? It's like the volumes just didn't exist. There weren't as many options exchanges. All the dynamics are totally different. So, from my perspective, I know with value, it's a little bit different, or growth, those kinds of dynamics. But you're talking about the derivative induced moves. It's like you have about 5 years of history at this moment where things are, where the history is even relevant.
So as we move to what we talked about last time, we always like to go back through what we said and then see if there was some validity to it. So what do you got here in this first chart?
Yeah. The funny thing about September OPEX, when I was thinking about this, and you and I were talking about what we talked about in September, it was this idea that realized vol was very low and markets were doing a lot of weird things. In my kind of like joking name of the presentation was vol pop, vol hunter or whatever, right? On the K-pop joke, saying like basically like, where's the vol? And this is kind of getting crazy. And, when you look at this, we saw in between when we did the September OPEX presentation and what started to happen after that, we really started to get these bids into vol and record call volumes and all of the things that really turned out to look like that July 2024 period where, remember when Jensen Huang was signing women's chests and stuff like that, right?
Yeah,
And
I
you're just like,
remember that.
this is crazy. I know it's going to break. And then in July, we dropped 5 to 10%. And we saw a lot of things that just were so reminiscent of that move. But what's funny in this chart was that all these ETFs here, right? Very, very low vol, meaning on this compass, had low implied vol, meaning people weren't pricing in vol into September, but they also weren't piled into calls necessarily at the time we did the presentation. That call bid did come in after. Also note gold here, right? Gold, very heavy call positioning into September. That's had some funny moves. Now, we talked about sticky correlation, right? Correlation went from 12 to sub 8. And sub 8 was where we started telling our members, like, you need to be worried about a market crash now, right? It's not a question of if it happens. It's just a question now of when. Now, it turned out that Trump's tweet triggered that, and we didn't see that tweet coming. At the time, we actually thought the low correlation would break at OPEX today, right? But Trump gave us the gift of volatility. So correlation here is talking about excess bullishness, and you could see we were driving lower, and it's that AI narrative that will always break this thing, right? AMD jumping 40% in a day, for example, pushes correlation down because the implied vols of single stocks rises up or goes so much higher relative to the index vol, right? And that's a measure of excessive bullishness. Realized vol, we got down into the sixes. So we went from nearest lows to lows right after this presentation. Implied vol in the gutter, when you're seeing 5% implied vol for short dated options, it literally can't go lower. There's nowhere else for it to go. And so anything that upsets the zero risk narrative suddenly creates spasms, right? And that's exactly what I think we saw here just recently. We talked a lot about the vol dynamic, how weird the VIX term structure was. When you looked at longer dated VIX futures, for example, they're so much higher than VIX. So you look at, 20, for example, 1 to 2 month out future versus the VIX index at 14 versus short dated S&P fixed strike vol at 5. Like the curve, how steep that was, just had to be, we needed the vol event to shake all of that out, right? Because that curve was so unnatural. And the
I
idea
apologize if you have this later in the presentation, but what does the term structure look like now?
it's in contango now, right? It has totally flipped. Backwardation. The short dated implied vol now is well above. That's in a true risk off position, right? Short dated options, short dated VIX futures are higher than the longer dated positions, right? And so now we've now unwound this, and I think that means that this relationship now is just going to become more normal into the end of the year. The VVIX had this weird structure as well. You could see there was this kind of gap, right? You could see this gap between what VIX is doing, and then there's a bid to VIX calls. So if you think about how reactive now the VIX is relative to the move, it's sort of like, well, there was this upside call demand in the VIX already. So the vol of vol is a little bit higher, I think, because of this positioning. Now, again, people were long VIX calls in theory. That's what the VVIX is telling us into this event. And you're going to have VIX expiration in a couple of days here. Don't you want to monetize those calls while you still can? Probably, right? And that, to me, is, again, why I think vol can mean revert into this expiration. The spread, again, between VIX and S&P was just very anomalous, right? We spent a lot of time talking about that. And now we also hit up these levels. The levels were 6,600, which was met into September options expiration. Then we had a short unwind period, right? And then we rallied to all-time highs. So the interesting thing about this is we moved into the all-time highs. We never got the big sell-off. We got more extremes in the market. And that's kind of where what is interesting, because we hit that extremes. I'll show that in a second, both in terms of volumes and all that other thing that led us to the stretched July 24th market, record lows in correlation, record call volumes, AMD, all these OpenAI names spiking like crazy, right? All that happening in the context of this very strange VIX and vol term structure. So you have all of these anomalies, right, that break historical relationships, and you just know it has to unwind, right? And so when you look at why Friday was so strange and how strange the current market is, and you see it through that lens of stuff was already bizarre going in and has to unwind, these relationships have to reset, then to me it makes this environment not so scary, right? in order to VIX 27 makes some sense given that context. This chart here was taken just a couple days ago. And we talked about the concentration of the top stocks, right? 38% of the top 10 stocks are, that's what the concentration of S&P is. This visual capitalist chart is from actually March, right? So this is a couple months old, but we've had this record correlation. Everybody already knows it, or concentration, excuse me. Everybody already knows this, right? It's like AI is the only narrative to keep the U.S. economy and basically the stock market afloat. Now, I don't necessarily think there's a problem with that. Like, that is the story, and everyone in the macro set talks about how if you remove the AI, spend and CapEx and data centers or whatever, the rest of the economy just stinks. I mean, that's fine. Like, if you don't eat any meals, you'll starve to death. It's like, that is real money. It's being spent. Data centers are being built. So if that's what keeps the economy up, then who am I to say about that? The problem about this is, from my perspective, is it's a very narrow band of stocks that dictate what happens in the markets, right? And so I don't know that this ever unwinds, but it is that thing to pay attention to, because if you have record call volume in AMD and NVIDIA and whatever, that means essentially the S&P is getting excess leverage, right, because of those very concentrated options positions.
Yeah, this is something we talk about in the fundamental world, like on the podcast all the time, because the idea is, I mean, these companies, to your point, these companies are doing really, really well. And so it's, for value guys like me, we want to like shake our fists at these companies and be like 40% concentration. It's a disaster. They're overvalued. But like on the other side of that, these companies have had great improvement in their fundamentals. They've had great, improvement in their free cash flow. They are in many ways completely different than the .com situation where, Cisco is trading at 100 times earnings. Like this is not that. So as much as I like to be a value guy, and we're kind of getting off the OPEX thing, but it is interesting just because from multiple perspectives, you could look at this. You could look at it in terms of dealer flows. What does it mean to have this concentration? And then you can look at it also from the perspective of the fundamental people.
100%. And I know everyone comes for my hot macro takes, and you're much more.
And my fundamental analysis, right? That's why they're here.
But the reason that I really watch this is because of the fact that these top 10 names are also where most of the options volume is in, right? And so you think about the levered impact of this stuff. You get the top 10 names and then you lever them up. So the S&P really just becomes a function of almost like, what is the options market doing in these top 10 stocks? It's kind of like, it sounds perverse, but like, I think there's like a ton of truth to that. And it's really kind of funny, to the point of AMD and Avgo jumping 10 to 40% on a OpenAI deal. It's like OpenAI suddenly is like in control now of the top 10 stocks, because like, they determine who they're buying GPUs from, and they apparently have unlimited funds to buy all these GPUs from anybody, that all comers. And you're just like, well, this is all kind of crazy.
And also to your point about their impact on the market, like some people like in the value space, like me, will say, well, we're going to get this bull market, but it's going to broaden out and all the other companies are going to do great and those companies are going to do poorly. Well, the reality is you're not going to get much of a bull market in the S&P 500 if that happens, because these companies they're such a huge part of the S&P 500. Like it's hard for all those other companies going up to overcome the big companies going down.
I mean, I would agree with you on that. And I think, the other thing is, like, why would you want to own, I mean, if tech gets overbought relative to all other stocks, which at some point you could start to argue that's true, then if those tech names go down, then the overall market's going to go down. It's not like the reweighting into maybe the equal weight S&P necessarily, I think, makes you money. I just think like we're so tech dependent that it's going to be hard for the initial, like, you need an initial big risk off move where everything sells off in order to, I think, reset those relationships. I don't think there's like this place you can hide out in value stocks. Yeah,
or at least you could, I mean, even if like people go back to like the 2000 situation, and there you did have a situation where, the Russell 2000-ish type things, the value-ish type things did okay while the market tanked, but like not the S&P 500. Like the S&P 500 can't do well if these companies aren't doing well. What's that?
Did the Russell, was it higher through that whole period, or just didn't lose?
Yeah, like a lot of value indexes were actually up in 2001, 2002, and or 2000, 2001, and 2002. But you have to look at the flip side of that coin. I mean, they had done like zero in 97, 98, and 99. Yeah. They basically weren't going up at all, or were going up slightly while the market was raging. So, but like from the perspective of the S&P 500, it's very hard for the S&P 500 to have a positive return if all the tech companies are going down, because it's market cap weighted and they're just such a huge part of it. It would be very hard for the bottom company. Other indexes could do well, but it'd be hard for those bottom companies to overcome what's going on in the big ones.
Yeah.
It's kind of a tangent on the fundamental side, but occasionally I like to throw some stuff in there.
Yeah.
So we can get back.
It also feels weird too, because there is, and this is, now we're straying way off from the options, but someone brought up a point, or I heard it somewhere, where sort of like the U.S. government has an incentive, or we have the incentive to make the best AI. It's like getting to the AI singularity over everybody else. And so it's like, we're just going to keep spending and to make sure that we are number one in the space. And I was like, I guess that kind of makes sense, that this is can continue to be kind of crazy. Like, I don't really know. Fortunately, at the end of the day, I look out about 30 days in time. So that makes my life a lot easier.
You don't have to worry about who's going to win AI in 7 years or something like that.
On the point of call volumes, this spike here was the 10th. And you can see this is calls here on the left, and this was puts on the right. Again, here was the 10th, right? How crazy that was. But look at the change in call volumes here, just trending higher into the 10th, right? We had record call volumes before we got to that date. And you don't see that same kind of convexity in puts, right? People just didn't care about puts. They were all chasing calls. And so you get call chasing, call implied vols lift up, correlation drops down, stocks start to go, things got stupid, as the title of the presentation, and that has to unwind. And you need a trigger for it to unwind, and it happened to be the Trump tweet. And that's why you get that bananas, relationship of vol going crazy on the single day. Now, we had written about correlation going under 8 as our risk off level. We talked about this on the 7th, because that's when we saw this correlation metric break below 8, right? Which is this mark right here. And for us, that was this signal that, okay, like this is the indexified level of how stupid things got. And so you have to start hedging for a risk event. Now, you don't know to the point of July, like it got stupid and then it kept getting dumber. And we chronicled this in July of 24. And then all of a sudden one day it was like, okay, risk is going off. And then you get a 5 to 10% drop. And then remember, VIX went over 50, right, on August 5th at the end of this move. So here we got that sub 8 reading, which to us is like, okay, you just have to put some hedges on, because it's just a matter of when things break, not if. Now, correlation has jumped and vol has jumped, but the S&P really hasn't gone down all that much, which is kind of the interesting thing. So now we've kind of like removed these overbought vol conditions. And if anything, the VIX moved to 27, starting to make vol a little bit rich and interesting to kind of maybe take an idea of shorting it. But that's all kind of happened today, right? 2 days ago when I started putting the presentation together, VIX was at like 20, and you're like, that's not an obvious sell. Like vol's not an obvious sell at this point, right? It's not quote unquote too rich. Of course, VIX can always spike more, but do you really want to short, 18 to 19% implied vol, or do you want to short 30%, 40% implied vol in the S&P? Like 30 or 40 is a lot more interesting, right?
Is the low correlation, does it have anything to do with like the dispersion trade, which you can explain what that is? But this idea that people talk about, this idea that, the index is pinned, but like there's a lot of movement behind the scenes, and like one thing's going up and one thing's going down. Does that relate at all to the fact that correlation got so low?
Yeah. And what that is it's a relative trade between single stock implied vol and index implied vol. So what that means in a way is I'm going to buy, NVIDIA, Apple, Tesla, AMD calls, and then I'm going to sell S&P calls, right? And that's essentially what that trade is. And there's different forms of dispersion, but that's just the general idea. So what the correlation index that we are focused on measures here is, what is the spread between those two, right? And the lower we go, what it means is that the single stock implied vols are much higher relative to the index. So if you think about the relative performance or momentum or breadth, right? Those things all kind of link together, because you have to have excessive bullishness is how that works, right? Because what happens in a risk-off scenario? We buy puts in everything. We buy puts in S&P, we buy puts in single stocks, and then correlation spikes because everyone is unified in the idea that all stocks are going lower. But when you have excessive bullishness, it's like, I got to own AMD options because OpenAI, right? And I got to own NVIDIA options because of OpenAI, and I can sell the S&P, the index vol, to offset some of those costs or to fund like those single stock call purchases.
It was interesting. I did, you were away, so you didn't do it with me this time, but I did a podcast with Noel Smith while you were away, and he was talking about that idea, and he was talking about how the dispersion trade had gotten pretty crowded, and it didn't seem like he had much on in that for the dispersion trade at all, because he was worried it was like a fairly crowded thing. So it's interesting. He's I guess it was kind of the same thing you've been saying.
Yeah, and this is a poor man's way of looking at that, right? And it's nice that it's an indexified measure because, at the end of the day, like someone said, like, how do you watch this intraday in a recent Q&A we did, and I was like, I really don't. Like, I want to see, like, are we way up here or are we way down here? Like, show me the extremes, and then I know this represents trades like what Noel was talking about as stretch. Do I have to know specifically what Noel is trading? Not really. I just know by looking at the extremes here that the relationships are all out of whack and there's risk involved in that, right? Risk either to the downside of the market, or if correlation's at like a 1, then you're like, okay, like everybody here is bearish on stocks. And generally what that means is we get a bounce, right? That tends to be what happens.
So this next slide looks at something we've been talking about in a bunch of our episodes, which is this idea of these big spasms we get.
Yes. And, Friday's spasm, this is from, I believe, Goldman. They were just putting this into context here. Like, you have to remember, realized vol in the S&P was at like a 6. I think it was a 5.7 is as low as it got on a 1-month basis, which is as low as it gets, right? The record low in realized vol was October-ish of 2017. We hit a 3 something, right? So if you take out that anomaly, 5 is the floor. And we went from the 5 floor, meaning the market is not moving at all, to a giant, I think it was a 3% intraday sell-off, right, in the S&P. And so that relationship, that return, right, was one of the biggest, going from extreme comps to like, what the heck just happened? You almost never see something like that. And that's what this is showing you here. We had one thing in December of 2024, and then you have to go all the way back to basically COVID type situations, right? To see moves like that. And to me, when I look at this, like, number one is you can see that even over the last 5 years, you didn't have what seems to be that many spikes, right? And then all of a sudden these spikes seem to be increasing. And I know that's just a chart observation. And if you're to study this statistically, you'd say that doesn't really seem to mean anything, Brent. But when I look at this, it just flags this idea in my mind of we keep having more and more stranger things happening. And when I look at options volumes increasing, leverage increasing, again, more ETFs and single stocks, I'm like, this is all, like, these bizarre things happening are happening at an increasing rate. And I think that's just going to continue to happen. Like, more unknowns, more strange things, more bizarre relationships forming, and then violent kind of unwinds and spasms, I think, is just going to become something more of a norm than what we've seen in past years.
And what's interesting to me is like the impactfulness of the news relative to the spikes. So like, if you look at this chart, you might say, oh, China invaded Taiwan or something like that. It wasn't. The president just tweeted something about tariffs. So right. I assume this has to do with what's going on in the underlying option market, but like relative to the value of the news, like these spikes are big.
Yeah. And look, if this was April where these tariff things were a huge deal, then I think the reaction maybe could be more warranted. But to your point, it's like, I don't want to talk about Trump taco because that gets everyone upset, but that is the way that everyone looks at this stuff now, right? It's like, what's the negotiation tactic? You say something like, Jack, you are the scum of the earth. I hate your guts. And then, then we shake hands 10 minutes later and make a deal. And like, China's doing like the same thing, like, get no rare earths or whatever. And then it's like, okay. And then Trump's like, well, you guys are jerks. And then, it's like, we all know the game plan at this point. And so why would the market have a 3% sell-off relative to that, reaction? And if you look at this similar thing, like, we had very low correlation into the DeepSeek thing at the end of January this year, right? Where DeepSeek came out and NVIDIA lost 14% of its value. You're like, that feels extreme, but correlation, again, was extremely low. People were piled into NVIDIA calls. What about the Tesla Trump situation, right? Remember, I think that stock also lost 14%. Those two events, NVIDIA and Tesla, were like two of the largest market cap reductions in history on a single day basis. And you're like, Trump and Elon are fighting. Should Tesla have lost 15% of value in a day? Like, that feels a little extreme. But it's the positioning, I think, that is really driving that. And so people go, must be the worst thing that's ever happened, what Trump just said. And it was just kind of another tweet. And so, again, it used to be the news, like, people would look at the reaction to the news as how much the news mattered. And I don't think you could do that anymore because of this, derivative online.
So I'm going to attempt to perform some options analysis here, which obviously is going to be wrong because I don't know what I'm talking about. But I'm wondering, like, when I think about the idea, we get this big one-day spike. And then I also think about the idea we don't get follow through on the next day. Like, to me, that says zero DTE has to play a role in this. But am I right about that, or is that wrong?
Yes. So I do think zero DTE matters, and I'm gonna take a quick break from the presentation just to hit on this idea here, because this is the zero DTE volume in purple, right? And so if I just zoom in a little bit on this, and we go to just this year, and I know this is a little bit tough to maybe see, but this is just this year. Purple is daily zero DTE volume in the S&P. So what tends to happen is when you get unknown risks, right, or known unknowns, we call them, Trump is starting a tariff war. That's the unknown. I don't know how that plays out on a daily basis. It could get way worse today. It could get, I don't know, but I know there's a risk. Or you look at this Silicon Valley Bank, SVB is what I was looking for. Crisis, right? It was another event. Like a new bank could fail tomorrow. I don't know. I can't play in the zero DTE space because I could get smashed, right? So, and I also have to focus on longer term options. So you see is we had stable at 57% zero DTE volumes. The tariff stuff flares and look at zero DTE volumes. They're gone. Not only because the intraday strategies don't work as well, but also I'm going to focus more on buying 1 month puts, 2 month puts, whatever it may be, right? I got to just zoom out on my time frame. And so what you saw here happen is we entered this new paradigm of 60 to 70% of total volume in zero DTE being of S&P volume being zero DTE. So we hit a record on 9/3 of 70% of SPX volume basically being zero DTE, which is crazy. And so what you suddenly see here is that flow on the 10th, and particularly on Monday, just kind of disappeared. Not fully disappeared, still 55%, but that zero DTE volume recedes in a major way, and that positioning recedes in a major way. And then what I think that leads to is less stability in the market, right? Because if you have 55% of volume or 60, 70% of volume is zero DTE, and that zero DTE goes away, then a lot of that stabilizing flows like Captain Condor and these other guys we talk about, they're not there anymore, right? Or their levels are much wider, or, you know, whatever it may be. So suddenly you get this kind of liquidity vacuum. And then not only that, the zero DTE flows, which are normally sort of selling into rallies and buying the dips and helping to stabilize the flows, they become chasing. And you can see this in the market where we'll get direction now, $7 or $8 billion of negative zero DTE deltas on the day, pushing the market down. And then on a dime, they flip and they go buy the market back up. So it becomes this sort of flow that goes from stabilizing markets to not offering liquidity anymore, which is destabilizing, to chasing, which further sort of destabilizes things. So again, just another dynamic of these ways that suddenly these options flows are really, you know, pounding the market. And the zero DTE flows make sense here because you can buy futures to buy the dip in a market like today, but if you're wrong, that futures can go against you and you get pounded, right? Or you can buy a zero DTE call or spread where you know what you have fixed risk and the same amount of upside. So you're kind of incentivized to hedge with zero DTEs, I think, in a lot of ways as well, and be very active in trading those, which again adds to some of the instability.
I know you've talked about this before, but it is insane to think about how much of the volume is zero DTE. Like when you see this chart and you look at it, it's like, it's pretty shocking to think that much of the options volume could be zero DTE.
I mean, it's crazy when you look at this trend, right? Like you see not many, you know, not all that long ago, 2021, you're looking at 36%. And then when they're launched every day, you're at sort of 50, and now you're at 60 to 70%. And so, you know, what I think also happens here is there are these intraday flows, right? They sell or they trade SPX options versus particularly like Tesla and NVIDIA, right? There's strategies that just high frequency, you know, trade those names back and forth. And so on that point, we put out this new report called Flow Patrol. And I think this is our Flow Patrol document, just to give you an idea of this. We have this report called Flow Patrol. And what this is showing us is if you look at the absolute change in SpotGamma open interest. So how much open interest is changed due to hedge funds buying real positions or retail buying real positions, right? Not day trading. And look at the flow. So here's the total volume in like the Qs or the S&P versus like the actual open interest change, right? So 5 million contracts traded yesterday, but only 400,000 of actual open interest changed, right? And so if you look at something like Meta or Taiwan Semi, you can see these volumes and you go, okay, the flow ratio, meaning the amount of volume that's trading versus people actually taking a position, buying a call or put and holding it because they think something's going to happen outside of today. You know, oftentimes those ratios are like 5 to 6 to 1, right? Meaning there's a ton of volume, but it doesn't actually translate into actual positions. And, you know, so again, here, look at Tesla, right? 2 million contracts traded on the day, but only 200,000 of change in open interest. Like that means there's literally 2 million contracts that was just buying here, selling here, buy, sell, buy, sell, buy, sell all day long. And that's leverage. So intraday leverage by day trading of options is just this massive thing and appears to only be growing as well as a strategy.
Just one more thing before we go back to the presentation. We talk about something similar on excess returns about passive investing, and it's not the same thing as this, but it's analogous in that people are worried that passive investing is getting to be too big. Like it's something like 40% of the market now. And there's concerns about, well, when is it too big and what is the impact? And I was thinking about the same thing here with zero DTE. Like as this rises, is there a level where it becomes concerning? Like if it goes from 60 or 70% to 90%, or does it not really matter? Is it not right to look at it that way?
I mean, at SpotGamma, I am grateful that we have 70% zero DTE, and I hope it continues to grow. But I don't think what I think is this all adds to instability, right? And more volatility. It's like the vol of vol is going to be higher. We're going to have more jumps like we did on Friday. And so there's two things I think about that. Number one is we're going to get faster, higher highs in markets, like blow off tops. And then we're also going to have disgusting reactions, right? Like what we had on Friday or in July of last year, where you're looking at your 401k and you're like, hey, great, my stocks are up 20% this month. That's awesome. And then 2 days later, it's down 40%. And you're like, what the hell just happened? And that's just going to be the way that these things work. Now, what's cool about that is that if you understand this leverage that's invoked in the system and you can take advantage of that, maybe you find value in a name that was just pounded because of some derivative trade, right? As an example, maybe, value's too long to think about that, but I think that there will be pockets of opportunity that expose trades in sort of a value or, value-like proposition because the derivatives market forces extremes, right? So if you're long a bunch of NVIDIA and NVIDIA's up 10% in, a day and call implied vols go to 200%, well, you can sell some calls against that because it's just gotten excessive, right? And that's what the driver is. And I don't think that most people, obviously in the passive inflow world or passive world are going to understand these kind of derivatives. It's just that, this is all trading a lot more like a Bitcoin crypto market now, right? As opposed to like a stable, mature market is kind of what it feels like.
Yeah, it feels like we're going to see more and more of, to your point, like nothing going on, huge spike. And like on a short-term way, like in the way we saw with the Trump thing, but also like in a bigger way in terms of like what we saw with the COVID bear market. It's like we just see these longer flat periods of not much going on, and then these massive spikes that are more short-lived maybe than they would have been in the past.
Yeah, and then you look at gold and even bonds now and obviously crypto space, like they're adding more and more ETFs, which on one hand you go, that's great. Like I would love to be able to buy Bitcoin via IBIT, right, in my 401k. Like that's awesome. I like that access, but do we need the 5x levered call selling gold ETF? Like, I don't know. And then you start talking about like, well, commodities, then you start talking about like, food and oil and all this other stuff. And then you go like I was talking to my dad the other day and he's like, I just, sold my 2x gold ETF and got into like a gold call selling ETF. I'm like, I didn't even know that existed. And I'm sure it's not a very big ETF, but you're just like, then you start to play with like, okay, it's funny money playing with, like NVIDIA's performance doesn't really matter about the stock. If the stock goes to zero, it does, but like ultimately the volatility in the stock doesn't really matter the same way I don't want like, my beef futures or cattle futures to be screwed with because, suddenly it costs 10x more to go buy hamburger because some asshole bought a 10x levered cattle ETF. It's a very weird thing.
Like I got us too much off track, so we can head back to the presentation here.
But that volatility, the volatility spilling into other asset classes, I think is something that, is like, okay, the financialization of everything does have to kind of take a chill. Like it's just getting a little bit, it's getting stupid.
So back to the presentation now. On the next slide, you're talking about this idea of volatility resetting.
Right, bad words. This was just realized vol. Again, went from record low, not record low, but the floor just to jumped really fast. And this is a pretty big jump. So this is one thing that I thought was really cool. So we go to this very quiet level of volatility 2 weeks ago to just suddenly like, bam, vol is here. And what is interesting about this is we just added this feature. It's coming out here in 2 weeks of the snail trails to show you over the last 10 days how these assets have moved. So if you think about stocks being or positions on the right side of this chart as call heavy, right? People are bidding up calls. And on the left side of this chart, they're bidding up puts. Does that make sense? So calls versus puts, left to right. Puts on the left, calls on the right. And then is it low vol or high vol is the y-axis. So what you started with is KRE, right? The regional bank index. Nobody cared about that really. If anything, it was catching a little bit of a bid because rates were coming down. And then all of a sudden we go, bam, some weird credit market event, fraud or not, I don't know. Jamie Dimon says there may be more problems here. And there's all of a sudden this big jump now in regional bank risk. So you see our snail trail go from bottom right, which is excess bullishness, to top left, which is now starting to get into excess bearishness. Now, I don't know how excess this can get if there's actual credit problems. So I'm not saying that's an extreme. But look at gold, for example, right? Gold was all the way down here, this purple trail, calls. Remember, we showed you this in September. Now we're at this really interesting spot in gold and silver where implied vol is as high as it's been in the last year, right? And people are hedging the crap out of downside now in these ETFs. That's what this is telling me. And if you think about who the average gold person is, they own the gold ETF. They own gold in their bunker. Jack, if you want to tell everyone your bunker is so we can go find it. But you're going to hedge out that risk, right? So you're going to buy puts probably there. So this is now extreme downside. So the thing to note here is if you want to hedge in gold, don't buy puts because they're extremely expensive. Put flies, put spreads maybe makes sense, but that extreme IV now is in play. Also look at, IBIT, right? The Bitcoin ETF, that was all the way at the right. Now it's on the left. Look at Qs and SPYs, same thing. Everything went from, in just the course of 10 days, from extreme bullishness now to like, crap, like we need puts. And then the thing that caught a bid is TLT, the government bond ETF. Obviously, that's going to be considered the safest asset in theory you could own at the moment. And now that is getting bid up, right? So it's been a real flip in risk just over this last 10 days. We went from binary extremes on one side to like, all right, now we're pushing the extremes on the other side.
Yeah, gold is interesting with it up so much. I mean, I guess people are just, people want to protect their gains. They're worried that the whole thing's going to reverse.
Yeah, and there's some evidence in some recent articles you read that the retail is starting to pile in now. You're seeing these screenshots of, and I think they're real images. I don't think they're AI generated. Who knows these days, of people lining up to buy gold bars. I don't know why you would do that. I mean, the liquidity of gold bars is horrible, but people are doing it apparently. So, there's definitely this froth and I think short-term exuberance in these metals. Now, if we have another credit problem or extended credit problems, and then Trump and Z are like, we hate you guys, and they hate each other, and unlimited tariffs on everybody and everything, then okay, like we have a problem, and gold is probably going to catch a bid. If I had to place a bet gun to head, I would think that gold vol's got to come down, which means that it's going to correct a little. So like stuff like put flies to me makes sense because they're cheap when you look at flies, and obviously no one would debate the fact that these assets have gone up a lot over the last, weeks and even months, right? So a correction, I don't think would surprise anybody. The key point here is that it's very expensive just to buy puts. So put spreads, put flies make sense, but be wary of that. And on the other side of the equation here, like puts are starting to get pretty expensive in Qs and spiders, like as we slide up. Because you got to remember, the last year of data, which is what these stats is based on, these rankings, includes the tariff, the April tariff stuff, right? Which we were on the edge of the literal financial abyss at that point, and VIX was just going bananas. So, yes, we're not at the highs of these charts, but for Q and Spider to go to the top of these charts, you literally have to do an April repeat, which I don't think is in the cards, but,
For the record, Brent, I haven't dug up the gold yet in my backyard bunker to sell it, so I'm still. When everything falls apart, you and I will be live for the OPEX effect on the bunker.
That'll be hilarious. The world has crashed, and so we're gonna dig up.
It'll be our highest rated episode ever.
To the point of vol resetting. So just to give you an idea of how fast this changed, this is this term structure in the S&P on the 9th, Thursday, right, is the blue line here. And then here today, this is actually from yesterday, we spiked. We're somewhere near closer this morning because vol has jumped more towards we're at this gray line, which is the 14th, so like kind of Monday. But you remember how I was talking about how in contango the vol VIX curve was, and term structure was pretty steep as well in terms of the contango. Now we've done more of the Nike swoosh thing, right, where it's more of like a ramp down as opposed to a ramp up. So the vol relationship is in the process of resetting, I think. And I also think the reason we're seeing again the 27 VIX is because of the fact that, just pointing to some of the other charts, people are already kind of long 1 month, call it VIX dealers are along those positions. And so now that term structure is really flattened out or inverted, which may normalize the relationship from some of the extremes we were talking about in September, right? Where it's like the biggest gap ever between VIX and S&P vol. The KRE, super interesting right now. And this is the term structure from the 1st. So 2 weeks ago, 1 month implied vol. this is about as low as it gets, right? In the bank space, could always think a little bit lower, but all is clear signal is what that is giving us. And then suddenly here in 2 weeks, you see this jump, right? Implied vol is shifted up. People want to hedge now puts in that space because of some of these potential credit problems. And this highlights a very critical thing to understand here. As much as I'm saying, like, I think vol's kind of gotten too extended, the biggest vol spikes happen when credit markets break. And that's because if you own a bunch of bonds in some regional stock and you're worried about those bonds losing value or possibly just being eviscerated, the way that you can hedge that is you buy equity puts, right? Because equity is going to be removed before the debt, right? In terms of the order of, help me out here, Jack. I'm just drew a brain fart. Equity has less priority than bonds. So you hedge out by buying a bunch of bank puts, right? And then if your crappy regional bank goes to zero, I've said crap a lot in this episode. If your crappy bank goes to zero, well, then your equity puts will pay off first, right? So you get excessive demand, and oftentimes that demand can be sort of regardless of what the vol price is, right? They become, just buyers of any resort of any level. They're less vol sensitive or price sensitive if they really think their bonds are going to go zero, and they just have to hedge. So that is where you can really get massive vol spikes, because you get this vol buyer coming into the market that's trying to hedge their bonds out, and they really don't care what the price is. They just have to hedge. And so that can be, again, a source of major long vol positioning, that if these banks start to roll over and it proves that it's not just fraud, but there's some systemic problem, a la Silicon Valley a couple of years ago, then you go, okay, like this is a potential major source of long vol, and you need to respect that.
It's interesting, and it's interesting how these things relate to each other. So Ben Hunt has an article that just came out recently about like potential issues and a potential catalyst that just happened in the private credit area. And we're actually, Matt Ziegler is filming a podcast with him today, which will come out the day after this one, about that. So it's interesting. Like, he's kind of seeing some things in the private credit area in terms of some catalysts. And then you're seeing like people in the option space actually starting to bet a little bit more on that same type of thing.
Yeah. Yeah. And, I don't know anything about bailouts or how much there is or there is not, but when you have this bid to vol, you have to appreciate the fact that what is going to reduce this? Well, we need to understand that everything is all clear, and everything is all clear, then all of a sudden, then we know that this vol can come down, and that could be a source for a rally, right? But at the same time, I have to appreciate that this vol is not going to come down, and it could go higher until whatever the risk is resolved. And so in this case, it's like, is there really problems? Is there not? I honestly have no idea. But now I have to start watching that and paying attention to that, because I can look at whatever I think the gamma positioning is in the market and feel good about all of those dynamics. But if the credit market starts to crack and fall apart, then it doesn't really matter what I think, right? Like, things, the equity markets are going to go down, and the two are intrinsically linked between, through this volatility space.
What's interesting on this next slide is we just did an interview with Andy Constant, and my thumbnail, which I was really pumped up about, was buy the tail, short the middle. And basically he was talking about how there's significant tail risks on both sides right now. And I think that's what you're getting at with this slide as well.
Yeah. And in our subscriber notes, I've been talking about this because at least before today, it was sort of like price is only 1% of all-time highs, and vol at the time was not terribly expensive. So I wouldn't want to short it. But at the same time, am I ready to buy it? And the answer to that is not necessarily, because the big risk events right now are the CPI, which again, I believe is coming on the 24th because of the closing. I think the date is, I don't know if that date is verified or not, so fact check that. And then the Trump Z thing, which I think is November 1st, right? So here is the term structure of the S&P in teal, and we have forward implied vol. What forward implied vol is showing you is essentially what the implied vol is between expiration dates. I like to think of it as a measure of, is the term structure too low or too high? And so when you see the forward implied vol readings, which are these lighter lines above, what that tells me is there's a risk event coming up. And so implied vol is going to be supported, right, by those risk events. Does that make sense? Normally, yes, forward implied vol is below the term structure. But because we have things like the CPI, right, and then the Trump Z meeting, which happens around here, as well as the Fed press conference, like, there's all this stuff at the end of the month that's going to keep vol elevated. Does that make sense?
Yes.
So if I'm sitting here saying, I want to short the VIX right now, which is a 30-day expiration, it's going to be hard for vol to come in because of the fact that those events create event vol, and that keeps the VIX elevated, or keeps implied vol elevated for any time past that date. Does that make sense?
Yes.
So if I'm sitting here saying I want to short a 20 VIX, knowing that these risk events are there, that doesn't seem that attractive. Now, VIX goes to 40. I know that's really extreme, so maybe I'll take a crack at that in case. And so the point here is like, okay, what happens when VIX is really extreme and it comes down? Well, that pushes the equity market up. So now that vol is getting to an extreme, that can be this lever that maybe I'm interested in playing. But that's my story for why the market could suddenly rally 2-3% because vol just gets smashed because VIX is at 27 and now VIX is going to go back to 20 just because it's quote unquote too elevated. So that can be this lever to push the market up. Earnings so far could be fine. Trump Z shake hands. CPI is not a big deal. Fed's like, I'm just going to keep cutting rates. And then you could easily see this market up 5 to 10%. I think we could get to 6,800 very simply in this market with any kind of a good news. Not only that, you got Trump. Maybe there's a Russia peace thing. I don't really know. There's rumors of this phone call. So it's like, you want to just talk about all the tails for the positive side of markets. So like, hard to believe the market doesn't rally sharply on just the resolution of that conflict, right? And then at the downside, now vol's getting a little expensive, but like, is there a problem with regional banks and credit issues? And this weekend, if you remember the August 5th crash, there was like some weird carry trade that unwound a little bit. And then suddenly, the VIX went to 50 on Monday, August 5th. So, we have this really weird situation right now, whereas again, if you're going to make me bet on something, I'm going to think that vol is going to come down because it's gotten to an extreme, but I'm not sitting here fully loaded up on any position right now because we have not only OPEX, which I think will reduce vols, but you do have this lingering credit issue, which could increase vols. And then to get the full vol slam, you really need these events to roll off. And so, you have to be just cognizant again of both of those tails. And I think anybody that tells you they have a really great handle on exactly what's going to happen over the next 2 weeks, is probably a little bit misguided. Now, again, if you're going to give extreme vols and I can bet on VIX eventually coming back down under 20, I think you and I would both bet at some point before the end of this year, VIX goes sub 20 again, right? That seems like probably the most reasonable bet at the moment, but that's like not likely something that happens until the start of November.
So this next slide, I assume you only put this in here to try to make me say a moose boosh. Did I get that right?
Yeah, a little appetizer, right? Because to this point of this conversation is on 8-2, right? We had this thing where we actually said to members and we said, look, this is a very risky weekend. You do not want to mess around in this market given all of the dynamics. And what's funny about this is that the current market looks a lot like that, except for at that point, the VIX was 20, correlation had started to spike, and we were in the middle of the OPEX cycle, right? August 2nd. There wasn't a big expiration or anything else changing. Now we have vol is relatively more elevated into the weekend, but we're also removing a lot of positions, and there's a fairly large VIX expiration in a couple of days here, right? So I really don't want to take much risk this weekend. Again, this is October 17th. I don't love that idea. I don't want exposure to a big vol spike either at this point, particularly over a weekend. But I think on Monday, you could see vol get slammed pretty hard if everything, over the weekend is fine and there's no, real increasing in rhetoric or whatever. And again, S&P is only down 1%. So while we're saying all this, you could also have a situation where stocks actually start to sell and then vol could easily spike again, right? And to that point, when we were looking at the possible lows in the equity market, this line here is negative gamma. And if you think about dealer flows inducing volatility to the downside, those flows in theory look like they could propel us all the way down into 63.30. So if I was going to write a scenario for kind of worst case scenario over the next 1 to 2 weeks, it would be something like that, right? Which is about a 5% drawdown. You get VIX into the 30 to 40 range because of a credit issue or Trump Z really battle it out or whatever it may be, right? You could easily spill down into that. That's a lot of stability on that left tail. And I think we all need to be cognizant of that. What would be different is if we were at, say, 67, 6,800 and we had all of this positive gamma that could support or be a floor, then I would say, okay, then the opportunity for a sell-off is not there. But right now we have a very soft underbelly to this market that you kind of have to respect, particularly, again, if there's some type of a credit issue.
So this next slide gets into what you talked about, which is we talked in previous podcasts a lot about, the left tail's cheap, and it's not anymore.
Yeah, it's not. And so do I want to buy puts right here? No, they're expensive. Doesn't mean the market can't go down. Doesn't mean VIX can't go higher. It's just like, and if you have something to hedge, like a big equity portfolio, well, what are you going to do, right? But as a trader, as just a speculator, and I'm very flat on positions right now, it's like, I don't want to pay 30 vol for, an at-the-money put in the S&P or whatever it is right now. It's like, That's expensive. Like, I'm good. And the other thing just to point out here is that the relationship between VIX and everything else is still odd to the point of VIX 27 is today. This is VIX versus volley. Now, volley measures at the money spider implied vol. And so what you see here is the relationship between these two, right? VIX is way higher relative to at the money S&P vol, which is just it's an anomaly. The only other time we saw these anomalies was the April tariff tantrum. There was a brief situation of this before 2022, and then you go back to like the COVID spike, right? Where there's this demand for vol, and the volatility VIX complex is operating in ways that the S&P kind of fixed strike complex isn't. The way to just sort of state this is like there's weird things happening, right? And this is a weird moment, but look at these spikes in time, right? They tend to happen in short bursts. Do you see what I'm saying there? It's not like this relationship gets weird and then VIX can maintain this premium over S&P vol on a long-term basis, right? What you tend to get is this relationship is very extreme, particularly have this expiration, then the relationship kind of normalizes. And to me, when this relationship normalizes, it means that vol is coming in. Does that make sense?
Yes.
So again, maybe VIX goes to 40 because something happens this weekend or 50 because something happens this weekend. But I think the clearing of VIX, and again, if it's not a major credit issue, the clearing with VIX expiration OPEX just may lead to, again, a reversion in vol, a short-term reversion. And then when we get through the November events here over the next 2 weeks, then maybe you get kind of a full deflation in volatility, which would correspond with a big end of year Santa Claus rally, right? Like you have to respect that, particularly with earnings, right? Because even if you have all these dynamics and NVIDIA is like, oh, guess what? We sold whatever 700 million more GPUs to OpenAI, then all stocks go up, and then it's the tokens over tariff thing. So when we were sitting here this morning, we were thinking like, hey, what is the trade, Brent? Just tell me what is interesting. I actually think that December, like 25 delta-ish calls, which is a decent out of the money call, is an interesting trade right now. Number one, this is our new calculator. We're launching this in 2 weeks, and it allows you to shift vol. So we all know that if you buy an option with extremely high vol and market rallies, vol tends to come down. But in this instance, I think call skew would pick up a little bit. So the purple line is the projected P&L of this trade if you hold it over the next basically 2 weeks, right? And the dotted line is what the market would estimate based on current vols. And the point here is that call prices relative to puts are not that high. Implied vol is a little bit expensive, but if you look at a December put, right, and you say what should vol do in this scenario, the vol is not going to change all that much, I don't think, because I think if the market starts to rally, call skew would increase a little bit. And so that would also benefit calls. And so what I really kind of like doing here is, and this is against pretty flat positioning, right? So if you're fully loaded up in stocks, maybe you don't like this idea, but I just think that we have to watch the tail, the right tail. We have to give a lot of favorites that if vol contracts, if the AI story is fine, if the trade deal with Trump is no big deal. And I think a lot of people, I think that's a safe assumption to make. Everybody just wants a deal. Let's go. Then you can hedge out a nice right tail move here for a pretty reasonable price. And so if I'm sitting here today and had to do something, I do have a couple of these calls on, and it's something that I'm thinking about here over the next 2 weeks. And I like the December call because the decay of this is going to be a little bit less. It gives me time for these events to play out, and I'm not exposed to super rich, buying a super rich option at this point.
So as we wrap up here, I know you have a special event here you want to talk about quick.
Yeah, I did. And so we're launching a bunch of new tools. One of them is this calculator. What's cool about this calculator is you can change the implied vol surface, and we update the calculations for you. And we help guide you on how to change those. No other calculator I'm aware of does this. In fact, we built this because I just couldn't find what I wanted. So we're launching this as well as 5 other new tools, including this snail trail thing you've seen here. We also have a VIX term structure that we're launching. So just to give you an idea of that, we were talking about how steep the VIX term structure is. Well, now you can see it's actually in that kind of backwardation, right? Front month VIX is now higher than other VIX futures, right? So this is another one of the tools. We're really excited about this. And so if you just go here, spotgamma.com/hidden-forces, as we roll these out, you're going to get free previews and free trials of all of these different tools. We're going to be doing a whole bunch of webinars on all these different dynamics, and it should be a lot of fun. So thanks for giving me the opportunity to bring that up.
Yeah. So as we wrap up here, I think we've given everybody everything they complain about with us. We had some macro takes here. We had the bad jokes. We had Jack's fundamental analysis. So
a few times.
Yeah. So we've got the whole thing covered. So keep the YouTube comments coming. We really appreciate everybody watching, and we'll see you next time.
Thank you for tuning into this episode. If you found this discussion interesting and valuable, please subscribe on your favorite audio platform or on YouTube. You can also follow all the podcasts in the Excess Returns Network at excessreturnspod.com. If you have any feedback or questions, you can contact us at excessreturnspod@gmail.com.
No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of the firms of the hosts or their clients.